Glad you're here. If you have been leaving your traditional IRA untouched because you don't need the money yet, there is a birthday that changes that permanently. The IRS requires you to begin pulling a minimum amount from that account every single year, starting at age 73, and that requirement does not bend for income, for health, or for the fact that you have other money to live on. Miss the deadline, or take too little, and the penalty is 25% of whatever you failed to withdraw. By the end of this video, you will know the exact formula the IRS uses to calculate your required amount, what changed in 2026 that moved the starting age, and 3 legal ways to reduce the tax hit before December 31st. In 2026, nearly 4 million Americans are hitting this threshold for the very first time. For an account holding $800,000, the mandatory withdrawal this year alone is over $30,000. Here is what makes this more than a standard tax bill. Every dollar you put into a traditional IRA or a traditional 401k or a 403b went in before tax. The government deferred that bill deliberately to be collected in retirement in a schedule the IRS controls, not you. The required minimum distribution, the RMD, is that schedule. In 2026, the peak of the baby boomer retirement wave, more Americans are turning 73 simultaneously than at any point in recent history. Over 5 years. The 22% marginal rate, a retiree with an $800,000 IRA, will send more than $35,000 in mandatory federal tax to the government on money they never asked to withdraw. That is the obligation. The only variable is how much of it you keep. In this video, you will know your required amount, the 3 legal ways to reduce it, and exactly what to do before the year ends. Before we get into the mechanics, if you are not subscribed to this channel, do that right now and turn on notifications. The IRS updates its distribution tables. Congress changes the rules without public notice. The Secure 2.0 Act moved the RMD starting age in December 2022, and most people still don't know it happened. The government sent no letters. No one called. The rule changed quietly, and the obligation followed. I cover changes like this because the people who need to know usually find out after the deadline has already passed. The Secure 2.0 Act was signed into law in December 2022. Before that law, the required minimum distribution age was 72. Before the original Secure Act in 2019, it was 70 and a half. Secure 2.0 moved it to 73. For everyone born between 1951 and 1959. That is the group turning 73 in 2026. For anyone born in 1960 or later, the age moves again to 75, under the same law. But if you are 73 right now, your RMD year is this year. The IRS uses a specific table to calculate the minimum you must take each year. It is called the Uniform Lifetime Table, published in IRS Publication 590B. At age 73, the distribution divisor is 26.5. Take the balance of your traditional IRA as of December 31st of the previous year. Divide by 26.5, and that result is your required minimum distribution for 2026. For an $800,000 traditional IRA as of December 31st, 2025, the math produces $30,189. That entire amount is treated as ordinary income on your federal return. At a 22% marginal rate, that is $6,641 in federal tax on money you may never have intended to touch this year. The divisor shrinks every year as you age. At 74, it becomes 25.5. At 75, it drops to 24.6. The required withdrawal climbs, even when the account balance holds steady, because the denominator keeps getting smaller. This is not a single event. It is an annual obligation that increases on a schedule the IRS designed, not you. If you hold multiple traditional IRAs at different institutions, the rules allow you to calculate the RMD for each account separately, and then take the combined total from any one account or any combination. The math still has to add up to the full required amount. Shortfall at year end is a shortfall regardless of how many accounts you hold. Missing the December 31st deadline or withdrawing too little is what triggers the excess accumulation tax. Under the old rules, the penalty was 50% of the amount not taken. Secure 2.0 reduced it to 25%. 25% of a $30,000 shortfall is still $7,500 in penalty on top of the income tax owed on that same money. The IRS gives first-time RMD recipients a one-time option to delay the initial distribution to April 1st of the following year. For 2026, that means pushing the first withdrawal to April 1st, 2027. The catch is that the 2027 RMD is still due on December 31st, 2027. Two mandatory distributions land in the same calendar year, both hitting your tax return at once, both stacking on top of each other, often pushing the account owner into a higher bracket than either distribution would have triggered alone. For most people, taking the first distribution 2026 produces a better tax result. The April extension is available. It is rarely the right move. If a shortfall did occur and the deadline has already passed, the procedure for seeking relief is to file IRS Form 5329 with a written explanation and a request for penalty waiver. The IRS has waived the penalty for first-time errors when the taxpayer corrects the shortfall promptly and provides a clear explanation. That is a repair option, not a plan. The plan is not missing the deadline. There is a second cost that most people who take their first RMD never see coming, and it arrives about 2 years after that distribution hits the tax return. It is called the Income-Related Monthly Adjustment Amount, the IRMAA. IRMAA is a Medicare surcharge that applies when your income crosses a specific threshold. Medicare Part B cost $185 a month as the 2026 standard premium. For higher income households, Medicare adds a surcharge on top of that standard cost. The surcharge runs from an additional $70 a month to more than $500 a month per person. A married couple, both enrolled in Medicare, pays the surcharge independently for each of them. Medicare does not use your current income to set the surcharge. It uses the income from your federal tax return 2 years prior. The first RMD you take in 2026 appears on your 2026 return. Medicare reads that number in 2028 and adjusts your premium accordingly. If that forced distribution pushed your modified adjusted gross income above the threshold, your Medicare bill increases for that year. You are paying it before you fully understand why. The IRMAA threshold for a single filer starts at approximately $106,000. For a surviving spouse who is now filing alone, that is the number that matters, not the higher threshold that applied when filing jointly. Someone with a $1 million traditional IRA taking a required distribution of roughly $37,700 combined with Social Security and pension income can cross that line without expecting to. The surcharge arrives as a Medicare premium change, not as a penalty notice from the IRS. That makes it easy to attribute to something else and never challenge. If Medicare is currently charging you a surcharge based on income that no longer reflects your situation, the appeal form is SSA 44. It exists for life-changing events, including retirement and a significant reduction in income. Filing it with current income documentation can reset the surcharge immediately, rather than waiting 2 years for the next calculation cycle to catch up. 3 legal exits from the RMD tax are built into the same statute that created the requirement. The first is the Qualified Charitable Distribution, the QCD. Federal law allows you to transfer up to $105,000 per year directly from your IRA to a qualified charity, and that transfer counts toward your RMD, without adding a dollar to your taxable income. The mechanism depends entirely on how the money moves. It goes from the IRA custodian to the charity directly. It does not pass through your bank account. It does not appear as income on your federal return. You satisfy the RMD without the income consequence. On a $30,000 RMD, directing $10,000 to charity via QCD reduces the taxable portion to $20,189. 22%, the savings are $2,200 in a single year. For anyone who gives to a church, a food bank, a scholarship fund, or any qualified nonprofit, the QCD is the most efficient tool available in this situation. The deadline is December 31st. The custodian must issue the payment before the year closes, and it must travel directly from the IRA custodian to the charity. You cannot take the distribution yourself and then make the gift. Call your IRA custodian and ask specifically for a QCD using those 3 letters. The second option is the Roth conversion, and the time to use it most effectively is before age 73. A Roth IRA has no required minimum distribution. There is no mandatory withdrawal age. There is no forced distribution schedule at any point. Funds converted from a traditional IRA to a Roth IRA before age 73 are permanently outside the RMD system. For someone who is 68 or 69, the window is still open. Converting even a portion of the traditional account in the years before 73 permanently lowers the base the IRS uses to calculate future required withdrawals. On a $600,000 traditional IRA instead of $800,000, the age 73 RMD drops from $30,189 to $22,642. That is a permanent reduction of more than $7,500 per year in forced taxable income every year for the rest of the distribution schedule. The conversion itself is taxable in the year it occurs. The benefit is permanent. The third option is the still working exception. If you are 73 or older and still employed, the 401k account at your current employer is exempt from the RMD requirement for as long as you remain working there. The exemption covers only the plan at the current employer. Old 401k accounts from previous jobs are not covered. Traditional IRAs are not covered. Only the active plan at the company you currently work qualifies. For someone still working at 73, every year inside that exemption is a year that balance grows without a forced distribution. The clock starts when employment ends. Retire in January, the first RMD for that account is due by December 31st of that same year. Gerald Patton spent 37 years as a civil engineer at the County Water Authority in Ohio. He started maxing his 401k contributions in the late 80s, maybe 1988, maybe 1989. He has never been entirely sure which year. He paid off his mortgage 12 years ahead of schedule. He never once carried a credit card balance, not in 40 years. Every Tuesday morning, same booth, the same diner, the same $4.99 breakfast special. Gerald turned 73 in the spring of 2026. His traditional IRA holds $800,000. He and his wife Dorothy, a retired school teacher who is 71, live on $6,000 a month, $2,000 from Social Security, and $4,000 from his county pension. The house is paid off. He doesn't need to touch the IRA. He knew the RMD existed. He didn't know the starting age had changed. His brother had mentioned 72 years earlier, and Gerald had always held that number as the rule. He was also waiting for his IRA custodian to send him a form or a notice. No notice came. IRA custodians are not required to calculate your required minimum distribution, prompt you to act, or contact you as the deadline approaches. That responsibility sits with the account owner. By October, Gerald called his custodian and learned his required distribution before December 31st was $30,189. A neighbor mentioned he had been sending charitable gifts directly from his IRA for years, that the tax result was significantly better than a regular withdrawal. Gerald looked into it. He transferred $10,000 directly from his IRA to the food bank his family had supported for decades. The custodian sent the payment. Gerald took the remaining $20,189 as a standard distribution. His taxable RMD for 2026 came out at $20,189, not the full $30,000. He kept $2,200. That would otherwise have gone to the federal government. He made the deadline. But the 6 months he spent waiting for a notification, that was never going to arrive. Nearly cost him the window to use it. Here is what to take from this video. The required minimum distribution is a mandatory annual withdrawal from traditional IRAs and 401ks, beginning at age 73, under the Secure 2.0 Act. The IRS calculates the required amount using the Uniform Lifetime Table in Publication 590B, and for an $800,000 IRA, that number exceeds $30,000 in year one. The penalty for missing the December 31st deadline is 25% of the amount you failed to take. The RMD also creates a second consequence that surfaces 2 years later, the IRMAA Medicare surcharge, when forced distribution income pushes your modified adjusted gross income above the threshold for your filing status. For a single filer, that threshold starts at approximately $106,000. 3 legal exits are built into the same law. The qualified charitable distribution sends money directly from your IRA to a qualifying charity and removes that amount from your taxable income entirely, up to $105,000 per year. The Roth conversion, completed before age 73, permanently removes that balance from the RMD system. And the still working exception delays the required distribution on your current employer's 401k for as long as you remain employed. The deadline is December 31st. No agency will remind you. Your IRA custodian is not required to calculate your number, send a notice, or contact you at all. The obligation is yours, and the window closes at the end of the calendar year. Act before it does. If this video helped you, subscribe and share it with someone you know who has a traditional IRA they have not touched in a few years. One conversation before December 31st is the difference between a plan and a penalty. I'll see you in the next one.